Hello, good morning everybody. Today we will discuss, I will explain about today's topic is admission of partner. Now, in the case of admission of partner, as I told you last time, you have to prepare profit and loss adjustment account or revaluation account, partners capital account, that is old partners capital as well as new partners capital account, and balance sheet after admission. If current account is given in the question, you have to prepare current account and all the effects at the time of admission related to general reserve or profit and loss account, profit or loss on revaluation account, or goodwill which will be credited or received by partners will be recorded in current account. Now, since we have not started with final accounts of partnership firm, during this lecture I will be explaining what is current account, when current account is opened, what are the types of capital in partnership firm, and that is fixed capital and fluctuating capital. So that I will be discussing afterwards. Now coming to admission of partners, which accounting entries are to be passed. So see, when partner is admitted, new partner is admitted, first of all you must know why new partner is admitted, why existing partners require new partner. Because if there is expansion of business, they can appoint people and get the work done from them. But when the question of finance comes, there is saturation point where finance requirement is more, or sometimes partner want to start new line or new product they want to introduce. In that case, additional hand will be required with finance. So he will be admitted and he will be part of owner of the business. So that is why new partner is admitted. Now, when a new person or partner is admitted, he must be given some share of profit. So the existing partners will have to share the profit to him. So how to find out new profit sharing ratio, what is sacrificing ratio, that we will be dealing with afterwards. Now, what are the entries? Now, in your question, it will be given that balance sheet will be given and information, adjustments will be given in the question. Now, on the liability side, outside liabilities are given. So liability side will consist of outside liabilities, partners, existing partners, capital accounts, and one more thing, and that is general reserve or profit and loss account, which will be given on the liability side. So your balance sheet consists of three parts. Now, what is this general reserve? So general reserve means it is the amount which is called undistributed profit. Undistributed profit means what? So whatever profit is earned by sole trader or by partners, it will be credited to their partners' capital account, and as and when the requirement is there, they will withdraw money from the business for their personal use. But sometimes existing partners will keep aside some portion of profit which will not be taken by them, and it will be kept for unforeseen event or contingencies. So it is a part of profit, it is actually a profit, but known as जनरल रिजर्व. जैसे हम लोग बाहर जाते हैं तो अपना पॉकेट में हम लोग थोड़ा सा पैसा बाजू में रख देते हैं, कभी काम में अचानक लगेगा तो. Similarly, in partnership business, general reserves are kept, which is shown on the liability side. So this profit, which is undistributed profit, belongs to old partners. So at the time of admission, this general reserve will be credited to partners' capital account. So the entry in this case will be general reserve account debit to partners' capital account. Now, in what proportion this general reserve or P&L account will be distributed? It will be distributed in their old profit sharing ratio. Old means existing at the time of admission. So old new will come when new partner is at the time of new partner when he is admitted. So this event is before that. So that is why I am calling it as old profit sharing ratio. So general reserves given the liability side will be credited or distributed among old partners in old ratio. Now I will show you 3 examples. One, when general reserves are given in the balance sheet, when general reserve and P&L account is given on the liability side, and third, when profit and loss account is given on the asset side. So when profit and loss account is given on the asset side, it represents loss. So whether profit or loss, it will be shared by old partner, because incoming partner has nothing to do with this. Now let me show you 2 examples which came in your board exam, and 1 example from my notes. Now let us try to understand. Now this is the question. Question came in February 2014. This question came in 2014. I will read the question. Mrs. Snehal and Meenal are equal partners in a business. Their balance sheet is as on 31st March 2017. Now here capital accounts of partner is given. Snehal 80,000, Meenal 45,000. Now here is general reserve. This. I am lefty, so I will be doing in this way. See here, this is general reserve. General reserve amount is 20,000. Now, Komal is admitted on 1st April. So, this general reserve belongs to old partners. it will be distributed in their old profit sharing ratio, and that is equal partners. So profit sharing ratio will be given in the question, and if it is not given, it is to be treated as equal. You have to take it as equal. So now, where it is shown, how it is shown in your capital account. Now, capital account is here. Partners capital account. Opening balance, buy balance brought down. Then buy general reserve 10,000, Snehal, Minal, old partners. So, the journal entry is, first journal entry I am teaching you. You can write down in your notebook, undistributed profit, general reserve, or it is called reserve fund, will be credited to old partners in their old ratio. Now, I am going to next problem where both general reserve and profit and loss account are given. This question came twice, and that is in July 2015 and July 2018. The question states, Ram and Krishna were partners sharing profits and losses in proportion of 2/3 and 1/3 respectively. So the ratio is 2:1. Their balance sheet is as follows. Now, balance sheet as on 31st March 2013. Ram's capital 96, Krishna's capital 64,000. And now, general reserve 18,000, general reserve 18,000, and profit and loss account 6,000. General reserve 18,000 and profit and loss account 6,000. So, when question gives you general reserve and P&L account, then again it will be distributed among old partners in their old ratio. So the ratio is 2:1, and it is credited in partners capital account, Ram's capital account, Krishna's capital account, 12,000, 6,000, 4,000 and 2,000. So, first entry is when profit and loss account or general reserve is given in the question on the liability side, then the entry to be passed is general reserve account debit or profit and loss account debit to old partners capital account. Entry for distributing profit or reserve fund to old partners in their old ratio, that is 2:1. This is the narration. Now comes the third type. And third type, that is if question tells you, gives you that profit and loss account is given on the asset side. Now this question, now so far there was no question on this when P&L account is given the asset side. It came in dissolution and retirement, not in admission. So this is from my notes, Shri Yash tutorial, bookkeeping and accountancy, question number 21. So as I told you, I have in my notes 25 minimum problems on each topic. Now here if you see, I will read the question. Balance sheet of X and Y as on 31st December 2004. The profit sharing ratio is 2:1. Now I directly will come to the question of P&L account. P&L account is given on the asset side, 6,000. This is 6,000. So this 6,000, when it is given on the asset side, it represents loss. See, solution I am not giving. I make students to prepare the solution, and then I will tell them the answer when they can check their answer from their notebook. Now, when profit and loss account is given on the asset side, it represents loss, and loss, so the journal entry will be old partners capital account debit to profit and loss account. Narration: entry for loss debited to partners capital account X and Y in the ratio of 2:1. So these three entries, rather two entries. First entry we learned is about general reserve or P&L account. Now we'll go to next part, and that is revaluation account or profit and loss account. Now, as I told you last time, in last lecture also, that when new partner is admitted, the assets and liabilities are brought exact value, market value, as on the date of admission of partner. So, there can be decrease in the value of assets, which is not shown in the book value. Then there can be increase in value of assets, decrease in value of liability, or increase in value of liability. So, revaluation account is, or profit and loss account is prepared for the purpose of showing the net effect of changes in the assets and liabilities. Revaluation account, now what is revaluation account? Definition, it came in your exam many times. So revaluation account or profit and loss account is a nominal account prepared at the time of admission or retirement or death of a partner. It shows, or the purpose of preparing revaluation account is to find out profit or loss on revaluation of assets and liabilities. This profit or loss again will be shown in old partner's capital account, because new partner account will not be affected till he brings capital, goodwill, whatever may be the case. So, so revaluation account or profit and loss account is prepared to show difference in increase, decrease in assets and liabilities. Now, when there is increase in the value of asset, it is a gain. Suppose, I'll be showing you example. Suppose the balance sheet reflects 5 lakhs as building, but on the date of admission, suppose the value is 6 lakhs. So 1 lakh is a gain. Gain will be shown on the credit side of revaluation account. If there is decrease in the value of asset, it represents loss, so it will appear on the debit side of revaluation. Again, when there is increase in the liability, it represents loss, so it will be recorded on the debit side. And if there is decrease in the asset liability, it is a profit or gain, it will appear on the credit side. So there is possibility of that unrecorded assets or unrecorded liabilities are to be recorded. So that will be done. This will be done at the time of admission of partner. So if unrecorded assets are to be recorded, then it is a gain. So it will appear on the credit side of revaluation account. If unrecorded liability is recorded, it will appear on the debit side of revaluation account. So now journal entries. Now in your revaluation account, you have to show the difference. I will draw revaluation account, small revaluation account, then I will tell you. You have to show the difference, and new value will appear in the new balance sheet. Revised value will be shown in the new balance sheet. Now I will draw a small revaluation account, and I will show you first, and then I will tell you the entry. Decrease in the value of assets. Just I am drawing it. See, this is the account you have to prepare. Revaluation or profit and loss adjustment account. Decrease in assets, increase in liability, difference. Increase in assets, decrease in liability, difference. And after closing the account, if credit side is more, then you present profit. If debit side is more, it represents loss. So this profit, it will be transferred to old partner's capital account in old ratio. So now I will show you example of how changes in assets and liabilities are shown in revaluation account. So here first problem we saw, in that it is Mrs. Snail and Mrs. Meenal. On the asset side, there are premises, investments, equipment, and bill receivable, debtors, less RDD, bank balance. Now, what are the changes made in this given in the question? Now, adjustment number, first come to adjustment number 4. Premises to be valued at 30,000. Now what is the value in question? It is 20,000. Now there is increase in the value of asset, premises, and that is 9,500 is, there is increase, so it will come on the credit side. Now
and equipment to be written off fully. So, as on the date of balance sheet, equipment has zero value. So, there is loss, there is reduction in the value of asset. So, it is shown on the debit side of revaluation account. Now, third adjustment, fifth adjustment, I'll come to RDD afterwards. Creditors allowed a discount of 1000. So there is decrease in the value of asset, which is a gain and will appear on the credit side of revaluation account. Now, come to that RDD adjustment. Now it says RDD to be maintained at 5% on debtors. So you have to calculate RDD always on gross figure. So gross figure means before deducting RDD, this is called net figure, this is called gross figure. So 5% on 1,10,000 comes to 5,500. So the RDD account, so if you deduct 5,500 from debtors, there is increase in the value of debtors by 5,500. 11,000 minus 5,500 is 5,500. There is increase in the value of assets because there is RDD has come down from 11,000 5,500. So when this account is closed, there is a profit. Credit side shows 16,000 total, debit side 5,000, the difference is 11,000. This is 11,000 is a profit which will be transferred to partners' capital account in their profit sharing ratio, and that is 5,500. So the journal entry is revaluation account debit to old partners capital account. Narration: profit on revaluation credited to old partners in their old ratio 1:1. So this is regarding revaluation of assets and liabilities, and then
Now next, see, so far we saw journal entry in case general reserve or profit and loss account is given in the balance sheet liability side. If profit and loss account is given on the asset side, what will be the entry? Then we saw that we have to prepare profit and loss adjustment account or revaluation account, which shows the changes in the assets and liabilities at the time of admission of partner. When new partner is admitted, assets and liabilities are revalued, they are brought to its proper value as on the date of admission of partner, and in the process of finding out revised value, there can be increase or decrease in the value of assets, or there can be increase or decrease in the value of liability, and there can be unrecorded assets or liabilities which will be recorded at the time of admission of partner, and the net effect of this, which will be found out from revaluation account, and it will be transferred to old partners capital account in their old ratio. If credit side is more, revaluation account represents profit and the journal entry will be profit and loss adjustment account debit or revaluation account debit to old partner's capital account, entry for transfer of profit to old partners in their old ratio. If profit and loss account is shown on the, if debit side of revaluation account is more, it represents loss on the revaluation and the entry will be old partners capital account debit to revaluation account or profit and loss adjustment account. Now coming to next part, and next part is when new partner is admitted, he has to bring some capital, because that is the main purpose of admitting partner, because existing partners are finding out deficiency of finance. They are in need of money. So when new partner introduces capital, then the journal entry for this will be cash account debit or bank account debit to incoming partner's capital account. Sometimes he might bring assets other than cash. Suppose he brings computer as capital, then he will record, the firm will record the entry as cash or bank account debit, computer account debit to incoming partners capital account. Now comes the next question, next part of goodwill. Now this goodwill part is very important and to be understood by you. Now first of all, what is the goodwill? So textbook says goodwill is reputation of firm. Now I will explain you goodwill in different situations. Now first of all, goodwill is explained given by Institute of Chartered Accountant India in Accounting Standard 26. Now goodwill is basically intangible asset. How to value goodwill, how to find out amount of goodwill is a question. So what is the goodwill if in case of sole trader? What is goodwill, treatment of goodwill in case of partnership? What is treatment of goodwill in case of joint stock company or private limited? Now when to record goodwill, how to record goodwill, whether it will be recorded or not is a question to be understood. So it is goodwill is, you say that reputation of firm. It is a future economic benefit which represent intangible asset. It should have realizable value. Now, in case of sole trader, now it should be measured in terms of money or price or consideration to be paid. Now in case of sole trader, I'll give you one example. Now there are shops nearby your house. Now that there are two shopkeepers, A and B. Now as on today, in today's market, the prices are fixed. MRP for each and every commodity or product is given. In other words, and now due to GST, introduction of GST, you get all products or commodities at same price all over India. It was not so before because each state were charging, each state was having their own rate of indirect tax, and that is why there was difference between prices charged by various producers or sellers or shopkeepers, sole traders, and that is why now that disparity is removed by the government after introduction of GST. Now, what is goodwill? Now, one shop, there are two shops nearby your house. Now, I am just giving a very small example. Both are selling Britannia bread. Britannia bread price is 28 rupees charged by A and 28 rupees charged by B. Now, surprisingly, if you think over, you have habit of going to one shop only, even though they are same. Now, why you go to that shop only? Why you go to particular medical shop? Why you go to grocery shop? Because that person, that sole trader, who is selling the goods, is giving you additional treatment or benefit. Now what is that? He might be giving home delivery. He might be saying, ये मत लो, ये थोड़ा सस्ता है, but ये मत लो, this is not good for you. So he will give you advice, and he will create good impression about you because of his selling ability or some quality. So suppose A has sold 100 breads yesterday, and if his profit is 1 rupee, and his neighbor is selling, he has sold 50 breads, so the difference between this 50 rupees is goodwill for him. Now, from accounting point of view, this is called internally generated goodwill. This is not to be recorded as per the accounting principles, as per the accounting standard 26 issued by Institute of Chartered Accountants in India. Internally generated goodwill is not to be created or shown. Now why goodwill is shown in the balance sheet? Why new partner should bring goodwill? So I am coming to the second part of goodwill, and that is goodwill in case of partnership firm. There is always admission question. Which states adjustment is there? New partner brings goodwill worth, he brings 10,000 goodwill, or it says goodwill is raised, and then it says goodwill raised is written off. So before that, you should know why this entry, why new partner should say that why I should pay goodwill. I am giving you capital which is required. Then answer to this question is that the fruits, hard work which is done by partners for previous 5 or 10 years, the fruits, now the firm is in profit, so these fruits will be enjoyed by incoming partner, and for that purpose he should bring goodwill, and which will be credited to partner's capital account. So in case of partnership, it is not that the partners are sacrificing or new profit sharing ratio is found out. That is called internally generated goodwill. So that is why goodwill adjustment is coming in your exam. Now, there are 4 types of treatment given in the goodwill part. When goodwill is paid privately, when goodwill is paid by partners, accounted in a partnership business, when goodwill is not, he is not able to bring goodwill, goodwill is raised and written off. So when goodwill is paid privately, it is not recorded in books of accounts because it is paid privately. Entry will not be recorded, but partners will record this entry in his personal books of accounts or individual books of accounts, and he will pay tax as an individual. He has to pay tax on that. It is not black money. He has to pay tax on that, and he will pay tax on income which is received by him at the time of admission. But since we are learning partnership for partnership accounts, since it is paid privately, entry will not be passed in partnership books of account. So we will write, while solving the problem, no entry. Now I will discuss second type, second entry, and then we will stop. Now, when partner is not able to bring goodwill in cash, it will be raised. The goodwill amount will be brought in the books of accounts by passing the entry. Goodwill account debit to old partner's capital account. Entry narration for this: goodwill raised, valued at, credited to old partners in their old profit sharing ratio. Now, remaining part we will discuss day after tomorrow, because tomorrow I will be giving lecture on economics. Thank you.